Good morning, good afternoon, good evening, YouTube. And today's topic is investing. I want to thank you all for tuning in to the previous videos, liking, sharing, subscribing. And I want to give a special shout out to my buddy Cedric Allums, who informed me that I had the incorrect settings on my previous videos, and that is why no one was able to leave a comment. So thank you, Cedric. Be sure to check out his page, Cedric Allums, Allums. So now you are able to leave comments in the section and we can have discussions. And especially with this one, because it's a very important topic. And I'm sure many of you may have questions, and I will try to answer them as best I can. This video is a long time coming. Well, not a long time, but I wanted to make the video back at the beginning of the year because of the statement I received from my investment account for the previous year. And it was such good news that I said I need to make a video. So it's finally here. And there's been a couple people asking me questions about what to do. I'm not a financial advisor. If you ask me, I could give you an idea. I can tell you what I do. That may not work for you. So I will advise you to go seek a financial advisor for specific things that you want to look at with your particular situation. So here we go. Investing retirement accounts is the specific topic. Basically, there are two types of investment vehicles available to you. There's IRAs, and I shouldn't say investment vehicles. They are two types of retirement vehicles available to you. IRAs, 401ks / TSP. IRA stands for individual retirement account, and it's just what it says. It's an individual retirement account. You deposit money in the account, and at age 59 and a half, you withdraw that money and you live on what you have deposited and the gains that you have achieved in that account. 401k is a employer sponsored account, as well as the TSP. So there's a few differences between the two, and we'll go over those. But today I want to specifically talk about traditional versus Roth. As you can see under the IRA section here, these are other retirement accounts that are available. SEPs are for those self-employed individuals. This is so you will be able to contribute to some retirement account. And simple IRAs, I think it stands for Savings Incentive something plan for employees. That is for companies that have less than 100 employees. So it makes available to their employees a retirement plan that they can match dollars to and get savings in there and hopefully some gains as well. And as you can see on both sides, there's traditional and Roth. And that's why we're going to tackle traditional and Roth today as part of this discussion. So a traditional, what does that mean? Well, the money that's coming out of your check is going into a traditional IRA account or a traditional TSP or traditional 401k account, and it is not taxed as it's going in. But when you go to withdraw that money, the money is taxed. So no tax going in, tax coming out. As opposed to the Roth 401k or TSP or IRA, the money goes in taxed and it is taken out tax-free. So think of it this way. Traditional money goes in, it comes when you take it out, it's taxed on the back end. Roth IRA is taxed on the front end. So now why is that important? Well, let's look at it. There's pros and cons of each, but I lean towards the Roth account as opposed to the traditional account. And I'll explain to you why. If you have $100 coming out of your paycheck and you are in the 10% tax bracket, that's what this 10% taxes mean. So in the account, in the IRA account or the Roth account or the 401k, not the Roth account, the 401k or the TSP account, if it's traditional, then $100 out of your check goes in, $100 goes into the account. At your retirement, if you are in the 10% tax bracket, then when you go to withdraw, they're going to take taxes out, 10%. So you withdraw $90, right? You put in 100, you take out 90. Over here, on the flip side, the Roth account, out of your paycheck comes $100. What gets deposited in the account is $90 if you're in the 10% tax bracket. So $100 paycheck, $90 goes into the account, and at withdrawal, if you're at the 10% tax bracket, it's $90, right? So these two accounts, if the tax rate is the same from now until you retire, they would have exactly the same amount of money, right? Because the only difference is one is taxed in the beginning and one is taxed in the end. The tax rate is what dictates the change. So let's look at a more realistic example here. In this particular example, it's more realistic because most people start out at a lower income level and they finish at a higher income level. We're talking about over the span of their career. Say if they started an even number 20 years old and they retire at 60, that's 40 years. You kind of expect to make more at 40 years into your working history than at 20. So in this example, same $100 out of your paycheck. This is a traditional account. $100 out of the paycheck, $100 goes into the account. When it's time to withdraw, because there's a 22% tax bracket now, you withdraw $78, right? 22% of $100 leaves $78 of balance. Now, on the flip side, the Roth account, $100 out of your paycheck, $90 now, taxes now, when you first start, is 10%. So $90 goes into the account, but look at the withdrawal. Later on in life, even though you're at the 22% tax bracket, you still withdraw the same $90 that went into the account because the taxes have already been paid for in the beginning. Okay, so that's the difference. The reason I chose the 22% is we're going to look at the tax brackets here on the next slide because of the income ranges. That's why I selected it. So just understand the big draw of having a Roth account as opposed to a traditional is that you can take advantage of the tax situation while they're low for you, and then when it's time to take it out, there's no taxes when your tax situation may be high. So here are the tax brackets. This is the old table and this is the new table. If you don't understand how marginal tax rates work, which is our system that we have here in the US, it's a marginal tax system. I'll explain it to you quickly here. Before we had 1, 2, 3, 4, 5, 6, 7. 1, 2, 3, 4, 5, 6, 7. And now we have the same 7. 1, 2, 3, 4, 5, 6, 7. So it's the same number of brackets, but look at the 10%. So what they did was at the 10% level, your income from 0 to 9,700, this is the single taxable income. Your taxable income from 0 to 9,700 gets taxed at 10%. If you're making, say, $30,000, then 9,700 to 39,000, it will fall in this bracket. But only over 9,700 gets taxed at 12%, and the rest of it, 700 and below, gets taxed at 10%. And then the same thing, 22%, same thing. It takes a certain amount of the income, taxes that percent, and then goes down as it gets towards 0. Hope I explained it correctly. But let's take an example. Say you make $100,000 a year and you're single, and you don't make it, but that's your taxable income. So you will fall in the 24% tax bracket, but that does not mean you'd pay $2,400, which is 24% of $100,000. You would pay 24% of roughly $16,000, right? Because $100,000 is about 16,000 over $84,000. So you pay 24% on that portion of your income, and the portion of your income in this part, 84,000 down to 39,000, would get 22%, and you just follow it on down the line. So what they commonly use is a effective tax rate. So the effective tax rate is where you take what you have actually paid in taxes and what you actually made, divide them, and that will give you an effective tax rate. So the one thing you should look at here is they changed, right? The 10% is the same, but they extended a few $100 here in the single, a few $100 here to include a little bit more income in the 10%. And then at the 12%, they did the same thing. They expanded, from 37 to 39, made that 12 instead of 15. And then instead of having the 25%, they split it between 22 and 24. So even from this, take this 39,000 to 160,000, including income, is still less than this particular. I shouldn't say less. It's still more income included in those lower tax brackets than this particular one here, which only went to 91,000 for 25%. And then you can just follow it on up the line. Next slide. Don't miss the wave. So what am I talking about? Don't miss the wave. Well, don't miss the opportunity to invest. But not only that, don't miss the gains that may have been realized from the investment. This reminds me of when I was at the Independence Bowl back home in Shreveport, and how the fans, they start the wave or whatever. Well, if they started it, but it took a little while to catch on. They started it down in the end zone area and went around, and you could just tell people missed it. They didn't catch it. Went around again. Got a little bit better, but it still wasn't full. So after a few tries, the whole stadium was involved in the wave. So imagine if you were out on the concession stand or out at the restroom, you come back, you say, what did I miss? You say, oh man, you missed the wave, man, the whole stadium wave. You're like, man, I missed it. I wish I would have been here to catch that. Well, that's what I'm talking about. Don't miss the wave. So here we have a little chart of the Dow Jones Industrial Average. And as you can see, some may know this. And so these dips and highs and lows, they go up and down. But over time, you see the trend of the average, it goes up. You can look at this dip right here. It's a giant dip, right? That was around the Depression era. You can come over here after 2000. That would be the .com bubble bursting. And over here, 2008, that'd be the housing crisis, the housing bubble that burst. So you're going to have some dips, highs and lows. But over time, the trend is up. So it ends up. A financial advisor I talked to recently described it as a person holding a yo-yo and walking up the stairs. The yo-yo is going up and down, up and down, up and down, but it's steadily climbing higher and higher and higher. And if you ever paid attention to when they announce on the radio or on TV what the Dow Jones is doing, and they'll say, oh, it's a new record high. They say that actually quite often. And I used to think, man, well, how could it always be a record high? Well, this is why. It's going up and down and up and down and up and down, but it's always climbing. So it's always going to have a record high. So as long as it's going up. So don't miss the wave again. So if you missed it this time, think about trying to catch the wave the next time and what you need to do to accomplish that. A lot of people say they are fearful of investing because of a crash, right? A bubble bursting, another bubble bursting, right? And they don't invest at all, but what you have to think about is, even though you're gaining and losing, you're still depositing money into an account. Like, you're still saving, right? You're having some type of saving vehicle. So here is an example, a real life example of what I'm talking about, the wave. This is my TSP account. And what we have here is at the end of 2018, which is the balance of $38,374.10. Right. So at January 1, 2019, this is my balance, $38,374. Okay. So here are the contributions for the year of 2019. The contributions are $8,800. That includes my contributions here, and then it includes the agency contributions. Now, when you are working at the post office, for example, I don't know about the other agencies. I can only speak about the post office because that's what I'm a part of. So the post office, once you become a career carrier and you are eligible to contribute money to the TSP, the post office will automatically contribute 1% for you for as long as you work for the post office. That's an automatic 1%, whether you contribute or not. In addition to that, the post office will put in an additional 4% if you put in at least 5%. That is what they mean by match. So they're going to match your 5% that you selected. They're going to match 5%. One thing to keep in mind is that all the agency contributions that they put in your account are going to the traditional balance, the traditional portion of the TSP. So keep that in mind. So that means when it comes time to retire, I'm going to have to pay some taxes on whatever this traditional balance is when I go to withdraw the money, because that money was put in tax deferred. It wasn't taxed when it was put in there. And actually, as you can see here, 2012 is when I actually started the Roth TSP contributions. Roth is actually a fairly new thing. I can't remember, or I don't know when Roth was introduced as an IRA, but here fairly recently it was introduced into 401k plans and TSP plans. So for me, 2012 was when the post office started offering the Roth account, and I immediately jumped on it. So you can pretty much say that 2012 is when the post office started offering the Roth TSP. So anyway, the $8,849.61 is what was transferred in funds to the TSP account. So we had a $38,000 balance. We had $8,800 deposited. So this is the calculation: beginning balance, 2019 contribution. So at the very minimum, with no gains or no loss, the balance is $47,223.71. Simple math, right? So now let's see what the actual balance is. The actual balance is $65,999.43. Well, why is that? Because the account realized a gain. It made a profit. And the reason it makes profit is because of share price. So I want to get stressed to you and try to convey to you that you shouldn't be fearful when the market goes down, because when the market, investing one-on-one, right? Buy low, sell high. So when you are investing in a retirement account or investing in anything, really like real estate, the value goes up and down, up and down, up and down, but you don't actually lose the asset. It's still there. It just has a lower value. So it's best that you ride the wave, right? Wait it out until it goes up, and then you can cash it in, or you can just hold on to it until it keeps going up. So always think about the shares instead of the balance. Always think about the amount of shares you are collecting, you are purchasing, because that's what determines the value of this account, the share price. If you put in $100 and share price is $5 a share, that means you purchase 20 shares. Well, what happens when the share price goes up to $10? So your 20 shares that you just purchased at $5 a share is worth $100. But if they go up to $10 a share, well, now it's worth $200 because you have 200 of them. So think about that. Shares, purchase your shares when the market is down, because you're going to keep contributing monthly or every paycheck to the account. That's going to stay the same. That's going to be constant. So the only thing is fluctuating is the share price. You some days you'll purchase more, sometimes you'll purchase less, but you will be purchasing them, and they will have a value when it's time to cash it out. So here is the next slide. As you see, this is 29%. That is my 12-month performance for the year 2019, which is awesome. The typical or the average return that you can expect is like 10 to 12%. So 12% is like the magic number. Well, 29%, that far exceeds that 12%. So that is a good year. That is a big wave. That is nice. And as you can see here, my actual company, because it's still growing because this year only $400 has been contributed, but it's jumped from 65,000 to 68,000. Another 3,000 is jumped, even though only $400 has been deposited into the account. And the reason for that is, again, the share price. If you go back here and you look at your statement, you should look at your statement at least every quarter, but it's best to look at it every month, because these changes in these share prices is what affects the balance. Which one is this? This is 2019. So in 2019, let's take the C fund, for example. It was $47.26. This is at the end of December. Well, now, I can't see that one. Let's go back. Here we go. So $47.26 back at the end. And now it is worth 48 cents a share. And I have to show you this. I explained this to you another time, why I have all my shares in the C fund. So, but let's look at the I fund. The I fund is $32.71 currently, or at the time of this, me pulling this statement, $32.71. But at the end of December, it's the same. So last year it ended at $32.71, and it's still at $32.71. The small cap fund, $56.27, went up $57.77. And again, the C fund, $47.26, went up $48.69. So there you have it. So that is why you want to always invest, because you're going to be purchasing shares, and those shares are going to be worth something when it's time for you to retire. Hopefully they'll be worth a lot more than less. Now let's look at the other things. So the traditional funds that the post office or that your agency is contributing for you, these traditional funds, these are the actual funds. They go to the G fund here, government securities. The G fund is a low risk, low reward fund, as well as the F fund, the fixed income index fund. As you can see, the share prices are fairly low for them, and it's like they won't gain much. They won't gain much in value because they're low risk. So the idea is that as you move closer to retirement, you may want to move your funds into a more safer environment, which is like the G fund or F fund. But while you have time to take advantage of the ever increasing market, you should invest in these more. They're more volatile, but they also give you more reward when they go up. One thing about these life cycle funds is that these funds kind of do it for you as far as moving money automatically to those lower risk funds. And these 20, 30, 40, 50 numbers represents how far out you are from retirement. So if you're closer to retirement, you may look at the 2020. And I don't even know what this L income is, but because I don't look at these because I don't mess with them. But 20, if you're closer to retirement, you look at say 20 years. It's not exact, but let's say close to 20 years. Might want to look at this one, and close to 30 years, you look at that one. Close to 40 years, that one. Close to 50 years, that one. So the idea is that the further out you have to retire, the larger fund you want to use, and these larger further out funds are going to perform more than these funds here that are closer in years to you. All right. So the account is still growing, and I explained to you the 29%. Okay, I wanted to cut in right quick before the video was over and show you the TSP website. I was browsing after I stopped the previous recording, and I just ran across a couple of things that I want to show you. You should actually go to the website and take a look, and it has all the information you need about investing in the TSP. And you don't have to log in to get the information. It's right there on the main screen. So the first thing we're looking at is the funds overview under investment funds here. So you can get an idea of how the funds differ from each other. So looking at the fund comparison matrix that you see here on the left side, you get a synopsis of pretty much everything that you need to know. The G fund and the F fund, they're mostly government type funds. So those are the safe bets. The C fund is stocks of large and medium-sized U.S. companies. The S fund is stocks of small to medium-sized U.S. companies. And then you have the international, and the L fund is a combination of all of the above. Now, the other thing you can look at is the objective of the fund. So looking at that, you can determine whether the objective of the fund is the same objectives you have as far as your retirement goals. So the G fund, looking at its objective is to have interest income without risk of loss of principal. So that risk without loss of principal, that's key, because that's saying that whatever you put in, the money that actually goes into the account, you'll be able to take out without any loss. So that's a good thing. It won't make a lot, but at least you won't lose anything at all. You just come out even. So next we look at, say, the C fund. The objective is to match the performance of the S&P 500. The S fund is to match the performance of the Dow Jones. Now, the Dow Jones is actually 30 large U.S. companies. So it's not the same companies, but the object, it's just meant to mimic or match the performance of the Dow Jones. And likewise, the C fund, it's not I may have some companies here that are in this 500 because S&P is 500 companies, but it may not have it's not the exact same 500 companies. It's just meant to match the performance of the S&P 500. And then you can look at the risk, right, and look at the volatility. So if you determine that you are not willing to accept a lot of risk or a lot of volatility, you don't have a high tolerance for that, then you would want to stay more towards the G and the F, or maybe even the L funds. So those of us that don't mind taking risk, we can move towards the C, the S, and the I. Me myself, I like the C because I believe it offers the best risk versus reward scenario. So you can take a look at that. Now, the other thing on here, it actually gives you some planning ideas. And this is really what I wanted to show you, because in the video that I just made, there's a term in here that it uses to describe the principle I was laying out. And it's under stick to your plan, I believe. Yeah, so here's some strategies. You should avoid chasing returns. You should avoid, trying to time the market, that kind of thing. But here's the biggest strategy. The biggest strategy is to be consistent about your saving. Be consistent. And that term I was talking about is called dollar cost averaging. So it says dollar cost averaging is the practice of investing a fixed amount of money at regular intervals, regardless of market conditions or asset prices. You buy more shares when the market prices are low and fewer shares when market prices are high. The end result is that your purchase price per share is lower than the average price of the shares over time. So that is the principle I was laying out when I was saying that, just because the market goes up or down, I was kind of saying you should, kind of be happy when it goes down because you get to buy more shares, right? So that is why. That's I guess, the technical term for what I was trying to explain. So it also, investment strategy, it also gives you some scenarios in here. There's something here called the cost of waiting. But here's something called ways to save. So it's just giving you samples of what to think about. If you take a short taxi ride, $8 daily, that's $240 a month. In 20 years, you'd have $110,000. And this is just based on 6%, which is a modest rate of return. Because remember, I said 12% is the magic number. And that magic number is there only because of historical data that has shown that the market has not consistently, but over time has gained close to 12%. So even at a modest 6% rate, in 20 years you'd have 110. But the biggest thing here is between 20 and 40 years. So the first 20 years you have $110,000 in the account. But look at the next 20 years, that same amount that you're depositing, it's gone over 4 times the amount. And the reason for that is compounding interest, right? So the principal has been placed in the account, it gained interest. Well, you take that principal plus the interest that it made, and now that is the total that gains interest. So every time it grows with interest, it gets bigger. It's like a snowball. And so it gets bigger and it gets faster. So that's why, you have 4 times the amount, even though it's the same amount of time that it was invested. And again, that's just 6%. So you figure, you had make it the 12% that you're looking for, and you could be in the millions. So keep that in mind. But the biggest thing, again, is to be consistent. And what I want you to take from me is that you should just get started. Don't wait. Don't miss the next wave. Get in there, get in the game, and take advantage of it while you can. That's all I have. So back to the video. So that is it for this discussion. If you have any questions, feel free to leave them in the comments down below. Please like, share, and subscribe, and turn on post notifications so that when the next video drops, you will be notified, and hopefully you get some enjoyment or some education out of it. Thank you all and have a great day. See you next time.